Good morning. Good morning. All right. I had my coffee at least. So we're going to talk about security tokens, tokenized securities, digital securities. A lot of hype, but I think the value prop is real. And so my talk is less technical. It's more focused on what's the value prop around it. We think it's the future of private investments. We're focused on private placements, private securities, private capital formation. Harbor itself is a platform plus a protocol. It's a software platform to fundraise and onboard and vet the investor. It's a blockchain protocol to ensure that that digital security always trades compliantly. And we're a bunch of pretty faces. Tough crowd. All right. I think at the start, it's worth going back and talking a little bit about what we mean. Another way to think about this is that a token is not a token. The words we use, token and wallet, were useful in the very beginnings of using blockchain technology because it helped us think of something physical and try and understand what's going on. But particularly in the world of digital securities, of security tokens, it's very misleading. Because when you say the word token, you think of something physical, a poker chip, a certificate, a wallet sounds physical, and that's not what's going on. It actually causes legal problems when you deal with the legal constructs around this, and it confuses the value prop of what you're trying to do. In the old days, and I can actually remember these days, when you had a private company and you were keeping track of who owned what stock, who owned what shares in your private company, you kept it literally in paper. It was a red leather bound notebook, and it had the embossed gold letters that said ledger. And whether it was shares in your company or some other set of ownership, you'd flip it open and you'd just write in it. Josh has 50 shares in Harbor. Bill has 100 shares. And then when somebody transferred it, you'd write another line. Josh minus 50, Bill plus 50, and you'd write a balance. And you just did that line by line by line. And then the next iteration was you keep it on an Excel spreadsheet. And so for most companies in Silicon Valley, and I'm sure in Boston, their capitalization table is kept by their law firm. It's always screwed up. It is always screwed up. And every time you do a financing, you got to undo it, figure out what's right, who owns what, and off you go. Ethereum, blockchain, it's a giant spreadsheet in the cloud. And so you got to go back to the idea of it as a ledger. It's not physical things that are moving around. The beauty of it is it's digital, programmable, immutable, all those things that we talk about. But fundamentally, right, it allows two people to transact together. When they do that with digital securities, they are writing literally to the books and records of the corporation. So what it allows to do is get intermediaries out and automate what you're doing, and we'll go into how that works. But it is not a physical thing moving back and forth. That token doesn't exist in a wallet. That smart contract, that set of entries is literally the books and records of the corporation. It is a substitute for that Excel spreadsheet in the back office of a law firm. So the value prop around going to digital securities, around using this digital ledger technology, is to unleash what transformed modern capitalism into private securities. So it was 450 years ago, modern capitalism kicked off, and it combined two new things. It was the combination of the two that really kicked things off. It was fractional ownership, and it was liquidity, secondary trading. In other words, a bunch of Dutchmen, a few Englishmen, meeting at the corners of Wall and Broad, meeting in coffee houses, started trading these newfangled things called stocks and newfangled things called joint stock companies. And it didn't take a lot. A few dozen companies, a few dozen traders, and you had the makings of modern capitalism, and things just took off from there. That doesn't exist today in the world of private capital. It does in the public markets. Public markets have highly fractionated ownership. Apple has billions and billions of shares, and it trades in microseconds. But private capital formation exceeds the public markets in every country around the world, or at least every country I've talked to. That's a world today in which there's zero liquidity, near zero liquidity. It's a world in which ownership is not nearly as highly fractionated as it could be. A highly syndicated real estate deal might have 50 people in it, whereas companies have millions and millions of shareholders. Some of that is due to the nature of the regulations around private securities, limitations on the number of shareholders, some limitations on liquidity, but a lot of it is just a technology problem because private securities today exist only on paper and have all the drawbacks and problems of paper. And I think what happens is when you digitize them, When you turn this into a format that allows you to trade it as easily as sending an email, you unlock liquidity, and that has a lot of value. You can fractionate ownership more highly. In other words, you can keep all the advantages of private capital formation, which is its low regulatory brain damage. You can do it quickly and easily and cheaply. But you bring a lot of the advantages of the public market to it. You can unlock liquidity that's there. The best mental model, I'll go into specifically how that happens, but the best mental model to use in the transition from paper securities to digital securities is a transition from snail mail to email. It's the same exact transition. So I can remember, because I'm that old, typing out a letter. God, it's a tough crowd in the morning. Typing out a letter, pressing print, throwing a piece of paper in an envelope, paying 50 cents, waiting 3 or 4 days and thinking that that was just fine. And then I distinctly remember the moment in the mid-90s where I started clicking send. Content, still written communication. Content's the same. It's still in the English language. But it's faster, cheaper, and easier by orders of magnitude to send it. And you can start doing things with email that you never did in snail mail. You can send it to 1,000 people as quickly and cheaply as sending it to one. You can archive it. You can search it. You can do all sorts of the great email marketing campaigns that we see. In the history of the world, nobody ever sent a letter in the mail to their buddy 4 cubicles down saying, where are we going to lunch? But we send those emails every day. Making things faster, cheaper, and easier is transformational. In the world of private capital formation, in the world of security tokens, digital securities, whatever you want to call it, the issuance of those shares, the formation of that private capital becomes incrementally faster, cheaper, and easier. But the trading, the liquidity, becomes faster, cheaper, and easier by orders of magnitude. There are going to be this coming week, and there were this past week, I guarantee you, private wealth managers at JP Morgan and Goldman Sachs who normally get their clients into this allocation into private capital investments. They're LPs in private equity funds, they own shares in private companies, they're in syndicated real estate investments, and they've got to get out. They got to get out because they've had a change in investment philosophy, they don't like the investments they're in, they've had a change in business circumstance, they need money. They've had a change in personal circumstance, and they need money. They've gotten a divorce or a coke habit. Those two things go well together. All right. And they got to get out. And what happens today in that paper world is that it takes months, sometimes years, to find a counterparty. They're phoning, they're faxing, they're emailing amongst a limited group of counterparties. When you finally, and they won't take your call if they don't need you, if they finally do find somebody, it takes weeks to consummate the transaction. The lawyers are sending red lines of documents back and forth. You're paying 10, 20, 30 grand for the privilege of getting out. It's good for the lawyer's kids, not good for your kids. All right. And at the end of the day, you take a huge hit on the valuation, the illiquidity discount. And when I talk to folks, it varies depending on how big an institution or how small an individual you are, but when I talk to people, the illiquidity discount, the hit they take, the numbers I hear most often are 40 to 60%. If you have a $500,000 position and 6 months later you walk away with $300,000, you've done well in getting out. When you digitize these shares, when you allow people to find each other in the exchanges and bulletin boards and OTC desks that are springing up and all the infrastructure around the security token marketplace, when you can send that email, digital security as easily and quickly as sending an email, all of those things get better. Months to years goes to hours to days to maybe weeks. It's not going to be milliseconds like the public markets, but it's going to be far better. Phoning, faxing, and emailing to a limited group of counterparties becomes finding each other on exchanges and bulletin boards and gathering places. Trading red lines for weeks and spending 20 grand becomes spending $100 on a fee in an exchange or paying 2 points in an exchange desk. And the 40 to 60% illiquidity discount that hit on valuation becomes less. Maybe it's 20 to 30%, whatever it is, it's much better than today. If you compare digital securities in the private realm to the public markets, you're going to think it's crap. You're going to be disappointed. It's not going to trade in milliseconds. It's not going to be shares priced at $10. But if you compare it to a world of today, it's far, far better. The question is, why isn't it like that today? Why can't you have that in a paper world? And the answer is because you need to have control over how this trades. You cannot allow Josh and Bob to trade directly in a paper world because you can't control what's going on. So I'll use the example of a REIT, a private real estate investment trust. It's got a very complicated set of rules it's got to follow. That private REIT has to have a minimum of 100 shareholders or it blows its tax treatment, a maximum of 2,000 per class of equity or it's got to go public. Non-US persons have to own less than 50% or it blows its tax treatment. Top 5 shareholders have to own less than 50%. Shareholders have to be accredited in the first year, and then thereafter there are caps, et cetera, et cetera, et cetera. Any form of private capital to maintain its exemption from having to go public and file an S1 and go through all that expense and hassle has complicated ownership structures. In a world of paper, you can't let buyer and seller transact directly, even if you wanted to let them, because you can't control for all those things. And so usually there are prohibitions on transfer. You have to go to that GP to get a mother may I, or you go to their transfer agent. You're literally faxing documents. No one's going to try and make a market because they never know if they're going to be able to transact. In a world of a digital security, of a security token, all those requirements can be programmed in. And you can think of it as the who, the what, and the where. Rules around who the buyer and seller can be, KYC AML, accredited investor status, special rules for affiliates and control officers. There are things about what the trade or what the cap table can look like, min-max investor numbers, concentration limits, holding periods, et cetera, and rules around where the trade can occur. And essentially, the architecture of Harbor, the architecture of some of the other platforms out there is similar, the good ones anyway. When you go to trade that security token, it's just like sending an email. And when I send an email, I have no idea what Gmail and Yahoo and Outlook are doing, right? I just know either the email goes through, I get an error message back. Similarly, when you send that security token, Harbor's in the background checking the who, the what, and the where. If they all check out, trade goes through, no one knows Harbor was ever involved. If any of them don't, we throw an error message, and it's like an email bouncing back. Error would result in too many investors. Error, Vlad@redsquare.com is not an acceptable investor, whatever it is. All my good lines aren't working today. What it allows you to do is to take out a middleman, to give people the legal right to trade under controlled circumstances that they're aware of, to allow people to come in, to make markets, to facilitate trades, and to do so in that highly efficient digital fashion, that email fashion, rather than in a world of paper and faxes and mother may I's. The theme of unbundling and rebundling, of breaking things down into smaller units and then combining them in ways that you never could before is, I think, exactly the promise of it. So Harbor is a software platform. You can syndicate far more widely if you can drive the investor interest. And today, when you do a private fundraising of a company, people are literally emailing documents, they're redlining, you're tracking wires. Like I said, it always ends up screwed up, always. With a modern software platform, you can pump through a large number of investors from around the world quickly and efficiently. I.e., if you can drive that investor interest, you can syndicate far more widely. You can bring the check size down. But what becomes really interesting is a world in which you have a bunch of those investments, you can now combine them in ways that you couldn't before and create investment opportunities that weren't possible before. So what we're really excited about is, for example, in real estate, and I'll get to other asset classes, is unbundling down to the individual asset level. So the first deal that's in the Harbor pipeline, you can go to harbor.com/investments and just check out what's happening. DRW, it's a shop in Chicago. It's got a currency trading arm, an FX arm. It's got a cryptocurrency trading arm. It's got a real estate private equity arm. They own a building in South Carolina, student housing, and they're selling just under half of it, $20 million worth of equity. Normally, that real estate asset owner, if it wanted to sell out a minority position, would sell it to one buyer, maybe 3 or 4 or 5. Not a lot of people can cut a check for $20 million. If you can syndicate it out more widely, you bring the check size down, you can draw a wider, more diverse pool of investors, and hence you should be able to get a better price for that asset. So $20 million slug of equity, maximum 2,000 investors, means it's a $10,000 check size. It's far more accessible. And from the investor side, they normally can't get into an individual building like that. They can't get into syndicated real estate at that size, and they can't get liquidity on the back end. And then what becomes interesting is a world in which not just you have one building, but you start to have a bunch of different buildings. So today, you can most easily invest in real estate in traditional REITs. They're highly liquid, they're on the public markets, but they're huge baskets of properties. They're enormous, they're huge regional areas or nationwide. What becomes really interesting is a world in which you go down to the individual asset level. Imagine a world, just like we're doing with the building in South Carolina, Imagine a world in which you start to securitize out or tokenize individual Class A buildings in the greater New York area. Now I can invest in an individual building level. That's going to trade relatively thinly. The due diligence to understand the investment in a single building, you got to understand the tenants, the cash flow, the building itself. But now, because we've unbundled into individual buildings, we've unbundled into small check sizes, $10,000, $20,000, $50,000 shares. What becomes interesting is how you can now rebundle it. I can buy up shares in each of those buildings downtown. I now have a downtown Class A fund. Or I can use a technology like the SET protocol, which allows me to create one token that wraps up any arbitrary set of tokens. And essentially, I can create a micro-custom ETF. I could take one share from each Class A building downtown, use SET, and I create a share that wraps them all up. It is a downtown Class A ETF. Simply not possible today. I can do the same for Midtown, for the Upper East Side, for the boroughs. Then using DYDX, I can go long downtown, short Midtown. I can go long Manhattan, short the boroughs. I can go long New York, short San Francisco. I do the opposite. I'd go long San Francisco, short New York. And it allows you to create investments that you can't do today. It allows you to increase or decrease your exposure, hedge your risks in ways that you can't today. If you think about when all the speculation around HQ2, Amazon, where's it going to go, you would have seen some really interesting trading patterns. You would have seen some really interesting investments. People hedging exposure, increasing exposure. If you think about ways in which you can do this to drive aligned interests with, to create stakeholders out of people who could otherwise be opponents. We are talking to real estate developers, bought up a lot of buildings in a downtown business district. They're interested in taking minority positions in these buildings, tokenizing them out, and then selling them at a reduced basis, essentially their cost basis rather than the increased value, to the building trades that worked on the buildings, to tenants in the buildings, to local merchants, to neighbors, to get to donating some to local charities. And the whole idea is to get the same effect that the startup companies in this room do with employee stock options. Rather than having folks feel like they're getting pushed out by escalating property values, have them feel like they have an ownership stake in the increased value that they're helping to create along with the developers in the area. When you unbundle into smaller units, you can do more things with it. You can create investments that don't exist today. What becomes interesting, too, is that you can rebundle in things that you don't normally associate with ownership of a security. So we're talking to sports teams. A sports team could take a strip of equity in the sports team, say an esports team or a professional sports team. I've talked to both. Take a 10% ownership stake in, say, the Patriots. Let's use round numbers. Let's say the Patriots are worth $1 billion. They're worth a lot more. But $100 million, if you want to raise money, if you're a craft, you want to raise money on the Patriots, your choices today aren't good. You can sell the Patriots, but who'd ever want to do that? You can raise debt on the asset, but you may be as levered up as you want to be. If you sell that minority interest to a single buyer, you have problems. Not a lot of people can cut a check for $100 million. So you get squeezed on valuation, and even worse, you get squeezed on control provisions. You want their capital, you don't want their input. This now offers a fourth way. Take that 10% strip of ownership that would be worth $100 million to a single buyer and syndicate it out. Maximum of 2,000 investors per class of equity. $100 million divided by 2,000 is 50,000. How many people in the Boston area would pay $50,000 to own a real share in the Patriots, where they'd get the pro rata share of the distributions, where they partake in the increased value in the sports company? My guess is that gets bid up way beyond 50,000. Now what happens is you can bundle back in rights not normally associated with securities. If you own a share in the Patriots, you could get first dibs on the best season tickets. You can meet the players after some of the games. You could have annual meetings with coaches and owners and others. You can take things that cost almost nothing to the team, but are incredibly valuable to the fans, and monetize them and drive fan engagement. For someone like the Patriots, I haven't talked to them, or someone like NBA teams, and I've had extensive discussions with some, it's really interesting to them. But to them, today, everything works great. Teams are incredibly valuable, everything's wonderful. But think about a WNBA team, or think about an esports team. WNBA league, a high valuation for a team would be $20 million. If they could take a 10% strip of the team for $2 million, $2 million divided by 2,000 is $1,000. How many parents who's got a daughter who's really into basketball would buy them a share in a WNBA team? that would allow them to meet their idols who are out there on the basketball court, that would allow them to feel a sense of ownership in the team, teach them about finance? My guess is a ton. For the WNBA team, they could raise capital at a premium valuation without getting up control. That capital is meaningful. More importantly, they can drive fan engagement. They can create super fans who aren't just fans, they're stakeholders and owners. Esports teams can do the same. You can bundle in things not normally associated with a security. I think what becomes really interesting is fundraising for blockchain-based companies. So ICOs are great in the sense of it drove a lot of interest in capital, also drove a lot of scrutiny and regulatory issues. But what was interesting to me is the ways in which you saw a flight to quality relatively quickly in ICOs and the ways in which investors in those ICOs evaluate. And what did they look at? They looked at the team, they looked at the tech, they looked at how they thought the product would get adopted. In other words, they were doing all the same basic investment steps that you do with a startup company. So now in a world in which ICOs are more difficult to do and they're not the fundraising model that they used to be, you can tokenize equity in a blockchain company and create a lot of the same dynamics. Reg CF is a great way to get equity and create stakeholders in the hands of non-accredited investors and common people, but you can't raise a lot of money. Reg D is a great way to raise a lot of money. It's got to go to accredited investors. What you can do is raise money, do a tokenized Reg D plus a tokenized Reg CF, either in quick sequence or at the same time. Raise your money with the Reg D, tokenize that equity, allow it to trade only amongst people on your cap table, or you could allow it to trade freely more widely. We have the technology where you can control the aperture of who trades. On that Reg CF, you're getting that out in the broader community. You're getting people invested in the success of your company and your protocol and your tech. And what you can also do is bundle in your utility tokens, your protocol tokens, along with it. So you have a tokenized share in the company, clearly a security. You need a compliance platform like Harbor to make sure it trades compliantly. And everybody who buys a share also gets a set number of the tokens. Rather than airdropping them out there or trying to figure out how do I do a compliant sale or sort of treat it like a security or sort of not, do a 2-token model, have a token out there that's trading that really is equity in the company, and then have your protocol token out there and get it into the hands of investors in addition to doing airdrops or however else you distribute it. But what I think is really interesting is if you're a blockchain company and you're not tokenizing your equity, then how much do you really believe in the tech? It's a great way in which you can bring liquidity to your investors and to what you're doing. I think when I talk to traditional financial institutions, there's an intense amount of interest and there's an equal amount of caution. I think the way this gets adopted for most folks is it's not either or, it's both and. So if you're doing a traditional fundraise, if you are raising money for a real estate project, you're raising a private equity fund, it's not either I go the tokenized route or I don't. Offer both. You raise the fund, there's 2 LP classes. There's LP class paper and LP class digital. Both have the same exact economic rights. The only difference is one's in paper, you're locked up for 10 years. The other's digital, you have certain legal rights to trade, and let investors filter out and see who chooses what. And over time, my guess is the digital gets greater and greater adoption, particularly in certain geographies like Asia that already have higher crypto adoption. But it's not either or. It's not some interesting but scary new world or the traditional world. You offer up both and let investors and capital filter out based off what they value. Fundamentally, more highly fractionated ownership and liquidity. It transformed modern capitalism and resulted in the public markets we have today, which are highly efficient. And we can make the private markets far more efficient than they are today. Where's May? How am I doing on time? 4 minutes. All right, I'll take questions, please. There's got to be some. Yes, sir.
You mentioned Reg D and CF, and there's, the limitations to that, but I liked all the ideas of tokenizing, like, places where people live and they can be an owner even if they can't afford the whole dang place. But I feel like a big limitation is going to be the Reg D and even the Reg CF that's supposed to be for, I don't know. I feel like this is still just going to cater mostly to people who already invest in stuff and are accredited investors.
Yes. So the question is, hey, is this only going to appeal to accredited folks? In other words, is it does this really democratize access? Well, a couple of things. One is raising capital is about raising capital. It's about money. So you get that from people who already have money, right? So I think you democratize it compared to where it is today, not to compare to some idyllic world where everybody's got an equal amount of money and everybody's a sophisticated investor. So for a Reg D, yes, it has to go to accredited investors, but that's actually a decently large slug of the American population. It's roughly 7% of adults. And you can do a Reg CF and get things out at a much lower check size to a much broader group of investors who don't have to be accredited. So I think what the technology is about is allow you to syndicate to the limits of the inherent interest in the investment and the inherent limits in the regulations around private securities. It doesn't allow you to circumvent those. But if you think of a real estate deal that could syndicate out to 2,000 people but only gets syndicated out to 5, that's a huge improvement. If you think of investing in private companies, say tech startups, today you can only do that really through VC funds unless you're already some accomplished investor with the connections. Or for most folks, the folks you're talking about, they have to go through an aggregator fund. So they're paying 1 in 10 to the aggregator fund, 2.5 to 25 to the VC fund. That company raising capital, if it can, even for a portion, go direct to investors, it can charge a 40% premium on the valuation. The individual investor is still ahead of the game. And what I think becomes interesting is you can set up special classes of equity for different audiences. So we're talking to a company that is reliant on an ecosystem of certain partners, sort of vendors and suppliers and partners on the ecosystem. They don't want their equity trading freely to anybody because sometimes it's scary having strangers on your cap table. We have a trusted parties feature where you can just specify either by rules or by name who's allowed to trade. So some companies only they do a fundraise, they approve the initial investors, then they'll allow those investors to freely trade amongst themselves, but nobody new comes on the cap table unless they approve them. This company wants to take their vendors, get them incentivized into the success of the company. So as long as you're on this approved vendor list, this approved partner list, you can buy in at a discount to the last round. You can trade freely amongst yourselves. But nobody new can come into that class of equity who's not an approved vendor. And if you're no longer in a partnership with a company, you got 6 months to sell. You get forced out. So I think there are really interesting ways to line incentives. The whole idea is same way we use employee stock options, create stakeholders amongst other people out in the community. There was a question over here, yes?
Yeah, so my interest is on the bundling and unbundling. Yeah, okay. So that has some analogy with securitization that happened in the financial sector for some time, and then the challenges we had in 2008. Yeah, of having to control quality and everything going south.
Yeah.
So what do you envisage going to be the quality control going down maybe in the next 10, 15, 20 years after things have been bundled and you don't really know what real assets are behind what you're buying?
Yeah, so it's a great question. So look, unbundling and rebundling isn't new. Those were CEOs, collateralized debt obligations, taking a bunch of loans, putting them together, taking a bunch of stuff, putting together, and chopping it up in different types of risk profiles and selling them out. We almost crashed the world economy in 2008 because quality standards slipped. So how do quality standards play out in a digital world? In some ways, you could take the position systemic risk will increase because it's now digital. It's now easier to do. We've talked to people about asset-backed securities. Those normally go in tranches of 100 million, 200 million at a time. Turn those into $1 million tokens. They're not going to be democratized down to accredited investors, but allow, rather than only the largest funds trading them, allow smaller institutions, family offices, others to get involved. I think it actually reduces systemic risk for a number of reasons. One is that if you bust things up into smaller pieces in total, it gets out more broadly. The other is what really happened in 2008 was concentrated counterparty risk and nobody knew it. AIG held the other side of the trade on virtually all of those CDOs, or particularly the CDSs, the credit default swaps, in an unregulated unit out in London, a non-insurance part of their business. And so when all of a sudden all that stuff started to hit, everybody realized they had concentrated counterparty risk. In a blockchain world, you can see how distributed out or how concentrated that risk is. If you're a regulator, you can pick somebody like Harbor who always keeps track of real world identity. So you can match up blockchain identity or wallet address with who owns what, and you can see instantaneously how concentrated that risk is. So I actually think that having a decentralized ledger of ownership where there's only one ledger, it's easily accessible, it allows you to monitor and therefore to reduce systemic risk. But quality standards, credit rating standards, that's a problem in any world. I mean, it's a problem today.
You talked about the Harbor platform and you mentioned set protocol. You also said Ethereum really quickly, early on. Can you connect those three, please?
Sure. So a digital security today, Harbor's focused on, Harbor supports Ethereum. We will support other blockchains over time. I think there will be a number of different blockchains to support different types of securities because they will have different trading patterns and needs. Things like a $50,000 share REIT in a single building is going to trade very thinly. I don't know, once a week, a couple times a month. Versus if I'm going long Manhattan, short the boroughs, that's going to trade much more rapidly. Why? One, it requires a ton of due diligence and specialized knowledge. The other is much more of a macro thesis, and so folks will trade more quickly. It's more speculative. So different blockchains have different trade-offs of security and decentralization and speed, et cetera. Why does Harbor support Ethereum today? It's because all the regulated infrastructure is there. If you want to do digital securities, you have to have not just wallet providers, you have to have qualified custodians, right? State-chartered trust banks, for example, BitGo. You need to have regulated exchanges that have ATSs. For this wonderful world in which you can go long downtown, short midtown, you can use set protocol to create micro-custom ETFs, you can use MakerDAO to do efficient loans, or the Dharma protocol, or Blockboard. All of those work very well with ERC20 standard tokens, and that's all present in Ethereum. So Harbor in particular will support other blockchains when they have the infrastructure that allows the issuance and trading of security tokens. Until they have that infrastructure, it doesn't really make sense.